The four-factor dividend growth portfolio is 2 years old now. Its total return for fiscal year number 2 was 33.27%. In my opinion, that is a fantastic return. If you asked me last November whether I would be happy with a 33% return over the next 12 months, my answer would be surely a resounding yes. In 2 years, this little dividend growth strategy is up 47.8%, giving it a compound annual growth rate of 21.57%. For perspective, the same investment into SCHD would have a compound annual growth rate of just 11.27%. While my strategy bested SCHD over the past 24 months, it did come up a little short of the S&P 500, 2.01% short to be exact, in terms of compound annual growth rate, that is. Beating the S&P 500 is a tough task, and it's not really my objective with this strategy. My main goals are to hit a 12% compound annual growth rate over the long term, and by long term, I'm talking about the next 5 to 10 years. I also want to see my dividend income grow, and for that growth to be well above the average rate of inflation. So let me explain how this strategy works, what changes were made for fiscal year number 3, and share a few more statistics so you can see how well the strategy is performing. The premise for the strategy is simple. Using a rules-based approach, I aim to identify the most opportune dividend growth stocks to invest in at any given point in time. I then hold these positions for exactly 1 year and repeat the process all over again. The strategy starts with a simple screening process that aims to identify high-quality companies that are growing and have committed to increasing dividends. The second step is sorting these companies based on 4 financial factors to see which stocks look the most attractive right now. I've talked about this process in great detail for the last 2 years, so if you're curious about the nitty-gritty details, you can check out one of the older episodes in this series. For now, let's spend a minute talking about the most recent rebalancing for fiscal year 3. The rebalancing took place on November 1st, and the number of chosen stocks was trimmed to just the top 20 stocks from the ranking process, opposed to the 25 stock portfolio in fiscal year 2. After 2 years of analysis, I found that a more concentrated portfolio, comprised of just the top 20 stocks, would have led to a better total return in both fiscal year 1 and fiscal year 2. Hence, the change was implemented in fiscal year 3. The overall theme for fiscal year 3 is a shift from technology and industrial stocks to energy and consumer staples. Let me break down the portfolio by sector so you can better see how it changed. I'll start with the technology sector that is still the largest component of this portfolio with a 30% overall allocation. In fiscal year 2, out of the 25 stocks in the portfolio, 10 were technology stocks with a 4% allocation to each. In fiscal year 3, there are only 6 technology stocks in the portfolio with a 5% allocation to each. Overall, that is a 10% reduction in exposure to technology. All 6 of the chosen technology stocks are repeats from fiscal year 2. They are ADP, ASML Holdings, Infosys, Lam Research, Monolithic Power Systems, and Paychex. The 4 technology stocks from fiscal year 2 that were dropped from this portfolio are Broadcom, Microchip Technology, Skyworks Solutions, and Texas Instruments. The second largest sector in the portfolio this year is the energy sector, with 4 stocks. In fiscal year 2, the portfolio only had 1 energy stock, EOG Resources. EOG remains in the portfolio for fiscal year 3 and is joined by ConocoPhillips, Devon Energy, and Diamondback Energy. The overall exposure to energy increased from 4% last year to 20% this year. Combined with the technology sector, these 2 sectors make up half of the portfolio. The third largest sector in the portfolio are industrial stocks. Last year, there were 7 industrial stocks in the portfolio, and this year there are only 3. Cintas is a new addition to this sector, and it is joined by Old Dominion and Watsco that are both repeats from the prior year. The 5 industrial stocks from last year that are no longer in the portfolio are Landstar, Masco, Fastenal, UPS, and Robert Half. The final 35% of the portfolio is split amongst the financial, consumer discretionary, consumer staple, and healthcare sectors, with 10% or 2 stocks from the first 3 sectors I just mentioned, and 5% or 1 stock from the healthcare sector. In the financial sector, the chosen stocks are MSCI and Visa. Both are new to the portfolio this year, and they replace MasterCard and Cohen & Steers as the financial stocks in the prior year. The 2 chosen consumer discretionary stocks are Dick's Sporting Goods, that is a new addition this year, and Rollins, that is a repeat from the prior year. The three consumer discretionary stocks from last year that are no longer in the portfolio are Williams-Sonoma, Home Depot, and Lowe's. The consumer staples sector is new to the portfolio this year, as we had no stocks from this sector last year. The two chosen stocks for fiscal year 3 are Ambev and Hershey, and Novo Nordisk is the healthcare pick, adding this sector to the portfolio for fiscal year 3. The one sector that has been eliminated from the portfolio is the materials sector, with SQM dropping out of the portfolio. The overall theme, as I mentioned earlier, is a shift towards energy and consumer staples, with each sector seeing a 16% and 10% increase, respectively, relative to the prior year. Additionally, there is a 5% increase to the healthcare sector and a 2% increase to the financial sector. Offsetting these increases are reductions to the industrial sector of 13%, the technology sector of 10%, consumer discretionary at 6%, and materials at a 4% reduction and no exposure in fiscal year 3. Whether these changes and the newly chosen stocks are favorable, only time will tell. We should know 12 months from now, when it's time to rebalance the strategy again. Given that this strategy has already had 2 successful years, the rule of thumb is that we are due for a not-so-great year. Fortunately for us, the stock market doesn't exactly follow such predictable patterns, and I'm staying optimistic for year number 3. The rebalancing also led to an overall boost in the forward dividend yield for the portfolio. Prior to the rebalance, the forward dividend yield was 1.91%, and now it stands at 2.39%. That is a pretty sizable boost, which also means that we should see more dividend income flow in over the next 12 months. This portfolio is rather small in terms of capital. I started it with $1,812.75 that was sitting idly in an old traditional IRA account. I haven't added any capital to this test portfolio since, and the current market value is just shy of $2,700. I have invested more capital into this strategy since, but this little isolated test portfolio is a perfect way for me to truly measure and test the strategy. The forward annual dividend income as of today is $63.84, which is 36.44% higher than the forward annual dividend income when this portfolio was initially launched 2 years ago. That equates to a 16.81% dividend growth CAGR based on the projected annual dividend income. Taking a look at historical actual dividends paid, the portfolio saw a 32.24% dividend growth rate between fiscal year 1 and fiscal year 2, which is pretty phenomenal. Just based on the projections for fiscal year 3, we are looking at a nearly 17% dividend growth rate. The actual dividend growth rate should be much higher, given that the projection does not factor in any dividend increases from these 20 stocks, nor dividend reinvestment. I know that investing in a fund like SCHD would give you a larger dividend stream right off the bat. That's certainly not something this strategy can compete with at the onset. But my hypothesis is that if this strategy can deliver a higher total return and a higher dividend growth rate relative to SCHD for a few years, it should also be able to bridge the gap in the dividend income it generates. I've been tracking how much dividend income a portfolio with the same capital investment into SCHD would have generated over the same time period. In fiscal year 1, my portfolio paid 36.11% less dividend income than SCHD. And in fiscal year 2, the difference shrunk to 27.29%. That's a pretty decent, almost 9 percentage point reduction. The SCHD portfolio with dividend reinvestment saw a 16.18% dividend growth rate between years 1 and 2, about half as much as my actual portfolio. I'm expecting to see another reduction in the dividend income gap in fiscal year 3. How much of a reduction we will see will depend on the dividend growth rate for each portfolio. I share this entire process in full detail with my Patreon community. Each month they receive a new top 20 list, as well as the full investable universe from which that list was generated. The shared file also summarizes the performance of each 4-factor list. I've been tracking this strategy on a monthly basis since June of 2023. This means that 6 of the lists have completed a full 12-month cycle. The average return for these 6 4-factor lists is a cool 28.5%. Which is far better than the return of SCHD, but slightly lower than the S&P 500. The 12 ongoing lists are a mixed bag of results. The December 2023, January 2024, and February 2024 lists all have double-digit total returns, but they are also underperforming both SCHD and the S&P 500. And the 9 more recent lists, with the exception of the most recent November 2024 list, are all performing rather sluggishly, with some grossly underperforming both benchmarks. Much like any strategy, I expected that the 4-factor strategy would cycle through more and less favorable periods. Anytime you're selecting a 20-stock portfolio, you take the risk of grossly underperforming the broad market. The S&P 500, for example, is made up of 500 companies, and SCHD includes 100 unique companies, giving investors more diversification. A more concentrated portfolio certainly increases your odds of seeing a more favorable return, but it also carries the risk of seeing a less favorable return as well. A few bad months isn't necessarily a sign to discount a strategy. To give you a little perspective, my portfolio beat SCHD in fiscal year 2, but it only outperformed the fund in 5 out of the 12 months. This means that during 7 months, I saw a worse return than SCHD. But the 5 months where my strategy proved to be better were very rewarding. There are no guarantees in the stock market, and unless you have a crystal ball, you're going to have to take some risks if you want to generate above average returns with no promise that you actually will. I don't recommend this strategy to anyone. Investing in an ETF or an index fund is a great way to not lose any sleep at night. I personally like to choose my own stocks to fill out my portfolio, be it through a strategy like the one I'm talking about today, or by performing due diligence on dividend stocks one by one. If a rules-based approach isn't your cup of tea, I also cover individual high-quality dividend growth stocks in my newsletter, Quality at a Fair Price. Each week, I share a high-level analysis on a new dividend growth stock, along with a valuation breakdown. If you'd like to check it out, there is a link in the description below. That's it for today. I'll see you here next month for another update on the saga of the 4-factor dividend growth strategy. Thank you for joining, and have a wonderful rest of your day.